Take a look at your last pay stub, not the number you actually received, the other one, the bigger one at the top, the one you technically earned but never touched because somewhere between your employer and your bank account, the federal government took its share. You probably didn't give it a second thought. It's automatic, invisible. It's just how paychecks work, except it isn't, not historically. For the first 154 years of the United States as an independent nation, and for the first 3 decades of the modern income tax itself, there was no permanent withholding from an ordinary American's paycheck. None. If you earned $100, $100 landed in your hand. And yet the government still collected income taxes, which means millions of Americans did something that sounds almost unimaginable today. Once a year, they sat down, calculated everything they owed, wrote a check for the entire amount, and in many cases stood in line at a government office to hand it over, face to face, eye to eye with the tax collector. So how did that actually work? Why did almost nobody pay income tax at all before the 1940s? What happens to a country when tens of millions of people suddenly get a tax bill they've never seen before and can't possibly afford? And why did the change, when it finally came, take a world war to force through? Because what happened in 1943 didn't just change accounting, it fundamentally rewired the relationship between your paycheck and your government, and quietly made the modern federal state financially possible. The answer runs through a Civil War experiment that failed, a department store executive with a radical idea, a cartoon duck, a young economist who'd spend the rest of his life regretting his own invention, and an entire year of American taxes that legally vanished into thin air. So let me take you back to the beginning. When the founders sat down to design the American government, they were working from a very specific fear. They just fought a revolution that started at least in part as a tax revolt. Stamps, tea, paperwork. Britain had learned the hard way that Americans took taxation personally. So the men who wrote the Constitution gave Congress the power to tax, because a government that can't fund itself isn't really a government. But then they did something subtle. They wrote in a rule that any direct tax, a tax laid straight on people or their property, had to be apportioned among the states by population. In plain English, if Congress wanted to tax individuals directly, it had to divide the bill among the states, according to how many people lived in each one, regardless of how much money those people actually had. That rule made a national income tax mathematically absurd. A poor state and a rich state with the same population would owe the same total. Nobody would ever agree to that, and that was the point. The founders knew exactly what they were doing. For the first 70 years of the Republic, the federal government lived almost entirely on tariffs, taxes on imported goods collected at the docks, plus excise taxes on things like whiskey. And even that light touch was nearly too much. When Alexander Hamilton's whiskey excise reached the frontier farmers of western Pennsylvania in the early 1790s, they answered the way their fathers had answered Britain. Federal tax collectors were threatened, beaten, and in at least one famous case tarred and feathered, until President Washington himself had to ride out at the head of 13,000 militiamen in 1794 to put the Whiskey Rebellion down. That's how allergic this country was to visible taxation. The government could enforce a liquor tax only at the point of an army. But, for most people, in most places, in most years, think about what the tariff system meant for an ordinary person. You could be born, work your whole life, raise a family, and die without ever once interacting with a federal tax collector. The cost of government was baked invisibly into the price of imported cloth and rum. You paid, but you never felt yourself paying. Hold on to that idea, because this entire story, all 154 years of it, is really about one question: should you feel it? Then came the war that broke everything. By the summer of 1861, the Civil War was devouring money at a pace no tariff could match. The Union was spending more in months than the government had once spent in years. So, in 1862, Congress did the previously unthinkable. It passed a real functioning income tax, and it created a brand new agency to collect it, the Bureau of Internal Revenue, the direct ancestor of today's IRS. Suddenly, there were federal assessors and collectors fanning out across the North, and citizens were filling out returns under oath. Even President Lincoln paid income tax on his salary. Verify, Lincoln's payments are documented. Some accounts say his estate later received a refund for overpayment. Confirm before citing the refund detail. And here's the detail most people overlook, the one that makes this story so strange. That Civil War system included withholding. The Treasury deducted the tax owed by federal employees straight out of their government salaries before they were paid. Collection at the source, as the lawyers called it. America's very first paycheck withholding, 80 years early. It didn't last. In 1864, Congress amended the law to exempt federal salaries, and in 1872, with the war won and the emergency over, the whole income tax was repealed. The machinery was dismantled. Withholding had been tried once and killed once. Remember that. It's going to happen again. For the next 40 years, the income tax became a political ghost. Farmers and populists wanted it back because tariffs quietly punished ordinary consumers, while the new industrial fortunes, the Carnegies, the Rockefellers, went largely untouched. Congress actually passed a new income tax in 1894. The Supreme Court struck it down the following year in a case called Pollock versus Farmers Loan and Trust, ruling that it counted as a direct tax and therefore ran into that old apportionment rule. The founders' mathematical wall still standing, still doing its job. So the reformers did the only thing left. They changed the Constitution itself. In 1913, the 16th Amendment was ratified, giving Congress the power to tax incomes without apportionment, and within months, a new income tax was law. Now, if you're picturing 1913 America groaning under taxation, don't. Picture this instead. The first Form 1040 was 3 pages long with 1 page of instructions. The tax was 1% on income above a $3,000 exemption, roughly $95,000 in today's money, verify conversion, and higher still for married couples. In 1914, out of a nation of nearly 100 million people, only about 358,000 returns were filed. Verify exact figure. That's not a mass tax. That's a tax on the top sliver of American society: bankers, industrialists, prosperous professionals. 99% of Americans owed nothing, filed nothing, and felt nothing. But here's a fascinating wrinkle most people don't realize. That 1913 law also included withholding. Congress required banks and corporations to deduct the tax from certain payments before the money ever reached the recipient, and for the second time in American history, withholding died young. Employers and banks howled about the paperwork. The system was so unpopular and so clumsy that Treasury Secretary William Gibbs McAdoo, MCADOO, the man whose own department benefited from it, recommended scrapping it. In 1917, Congress did exactly that, replacing collection at the source with mere reporting at the source. Your bank would tell the government what it paid you, but collecting the money was your problem. Tried twice, killed twice. And so the face-to-face era settled in. If you were one of the few who owed tax, here's what your year looked like. The deadline wasn't April 15th, it was March 15th. You gathered your records, computed your own tax, and paid it yourself, either in one lump sum or in quarterly installments. Many people paid at the office of the local collector of Internal Revenue, and every March, newspapers described the last-minute crush, lines of taxpayers sneaking out of federal buildings as midnight approached on deadline day, checkbooks in hand. Verify, March 15th. Deadline is well documented through 1954. Confirm a specific newspaper seen before adding name details. Paying federal income tax was an event, deliberate, physical, slightly painful. You knew to the dollar what your government cost you because you handed it over yourself. And for nearly 30 years, that was the deal. It worked for one simple reason: almost nobody paid. That was about to change, twice. The first change arrived quietly wearing a disguise. The Great Depression had done something to American politics that no panic before it had managed. It convinced a durable majority of voters that the federal government should stand underneath ordinary people when the economy collapsed. But that idea came with a price tag, and a tax system built to skim only the top sliver of society couldn't pay it forever. Something structural had to give. In 1935, in the depths of the Depression, Franklin Roosevelt signed the Social Security Act. To fund it, the law created a payroll tax, and from the very first collections in 1937, that tax was deducted directly from workers' paychecks by their employers. Withholding was back in America on tens of millions of paychecks. And here's the remarkable part. Nobody rioted. Why? Framing. Social Security wasn't sold as a tax. It was sold as an insurance premium, a contribution to your own old age account. Workers even got personal account numbers, those 9 digits you still carry today. The deduction felt less like the government taking and more like you saving. If you want one human image for what that bargain looked like, take Ida Mae Fuller, a legal secretary from Ludlow, Vermont. She paid into the system for just 3 years, a total of about $24.75 in payroll taxes. In January 1940, she received the first monthly Social Security check in American history for $22.54. She then lived to be 100 years old and collected nearly $23,000. Verify figures. These numbers are widely cited by the Social Security Administration, confirm exact amounts. Not a bad return on $25. Her check number, by the way, was 00000000001. So, by 1940, the machinery of paycheck deduction existed, humming away in every payroll office in the country. The income tax, meanwhile, remained what it had always been, a class tax touching maybe 5% of workers. 2 separate worlds. It would take exactly one Sunday morning in December to smash them together. On December 7, 1941, Japan attacked Pearl Harbor, and the United States entered the most expensive war ever fought. The numbers stopped meaning anything at normal scale. Washington would ultimately spend on the order of $300 billion on the Second World War, verified total, at a time when the entire federal budget a few years earlier had been about $9 billion. Tanks, bombers, 2 ocean navies, millions of soldiers' paychecks, and a treasury that also desperately needed to pull money out of civilians' pockets before chased scarce goods and ignited runaway inflation. Taxes weren't just revenue anymore, they were a weapon against rising prices. So, in October 1942, Congress passed the Revenue Act of 1942, a law the president himself called for as the greatest tax bill in American history. It slashed the personal exemption, raised rates across the board, and added a 5% victory tax on incomes over $624 a year. A threshold so low, roughly the modern equivalent of taxing almost everyone with a steady job, verify conversion. The transformation was staggering. In 1939, about 7.7 million income tax returns were filed. By 1942, it was nearly 37 million. By 1945, around 50 million. In half a decade, the income tax went from something 5% of workers paid to something roughly 3/4 of them paid. Tax historians, borrowing a phrase from the law professors Stanley Surrey and William Warren, call it the moment the income tax changed from a class tax into a mass tax. Imagine the entire populations of California, Texas, and New York today suddenly receiving a bill from an agency they'd never dealt with in their lives. That's the scale, which created a very practical, very human problem. Tens of millions of Americans, factory workers, waitresses, farmhands, had never filed a tax return, ever. They didn't know what a deduction was, they didn't know where the forms were, plenty of them frankly didn't believe the tax applied to people like them. The government's solution to this problem is one of my favorite details in all of American fiscal history. Treasury Secretary Henry Morgenthau, Jr., Morgenthau, went to Hollywood, specifically to Walt Disney, and in early 1942, movie theaters across America began showing a short animated film called The New Spirit, in which Donald Duck learns step by step how to fill out his income tax return. Occupation, actor. Dependents, 3 nephews. Donald gets so fired up about funding the war effort that he races his tax return from California to Washington in person. Tens of millions of Americans saw it in theaters, verify audience figures, and polling at the time suggested the film measurably increased people's willingness to pay, verify Gallup figure. Irving Berlin, the man who wrote God Bless America, even composed a song for the campaign called I Paid My Income Tax Today. The federal government was using a cartoon duck and a Broadway songwriter to teach a nation basic accounting, and it worked. Taxes to beat the Axis. And there was one more provision buried in that 1942 law, easy to miss at the time, and enormous in hindsight. The little 5% victory tax came with its own collection mechanism. Starting in January 1943, it would be deducted directly from paychecks by employers. For the first time since 1917, ordinary American wages were having federal income tax withheld at the source. Only a sliver of it, only the victory tax portion, but the pipe had been laid. The question now was whether the entire income tax would be poured through it. But behind the cheerful propaganda, the Treasury had spotted a mathematical trap, and it was closing fast. Here's the trap. The income tax was still collected the old way. You paid this year for what you earned last year. In March 1943, all those brand new taxpayers would owe the full tax on their 1942 incomes, in cash, in lump sums or quarterly chunks, out of savings most of them didn't have. Meanwhile, the government wanted to move everyone onto a pay-as-you-go system, with tax deducted from each paycheck as it was earned, the way Social Security already worked, because the war needed money now, not a year from now. But bolt withholding onto the old system, and look what happens to an ordinary family. A machinist earning $2,500 a year would spend 1943 paying off his entire 1942 tax bill and having his 1943 tax pulled from every paycheck. 2 years of taxes, 1 year of income. Multiply that by 40 million households in the middle of a war that depended on those same households buying war bonds and staying out of debt. The Treasury's own General Counsel, Randolph Paul, later wrote that the problem of transition was genuinely hard to solve. Washington was stuck. And that's when a department store executive walked into the biggest tax fight in American history. His name was Beardsley Ruml. Beardsley Ruml. Verify pronunciation, and he may be an unusual figure in this whole story. Ruml was the treasurer of R.H. Macy and Company. Yes, the Macys, the one with the parade, and at the same time chairman of the Federal Reserve Bank of New York, retail executive and central banker in one large cheerful body. He'd earned a doctorate in psychology from the University of Chicago, had run a Rockefeller philanthropic fund, and had a reputation, lovingly documented in a 3-part New Yorker profile, as a kind of professional idea man, a self-described lazy thinker who did his best work sprawled on a couch, generating schemes for other people to execute. In 1942, lying on that couch, Ruml came up with the scheme of his life. His argument started from a merchant's instinct. At Macy's, Ruml liked to say, "Customers pay for what they're buying now. No store would dream of making you pay off last year's purchases before you could buy this year's coat." So why did the government, his plan, move the entire country onto pay-as-you-go immediately, with taxes collected from income as it was earned, and simply skip the old bill? Forgive 1942's tax liability. Wipe it out. Not because taxpayers deserve to gift, Ruml argued, but because under his plan, the government would never miss a payment. Money would flow into the Treasury every single payday forever, without interruption. The government wouldn't lose a year of revenue. Taxpayers would just stop being a year behind. To the average American staring down a terrifying March deadline, this sounded like a miracle. And Ruml, unlike most men with tax plans, knew how to sell one. He'd spent his career marketing other people's ideas, and now he marketed his own, pitching it to the Senate Finance Committee in the summer of 1942, then going over Washington's head entirely. Pamphlets, radio appearances, newspaper columns, all built around a slogan any shopper could understand. Skip a year, pay as you go. Polls showed overwhelming majorities of the public behind him. Verify specific poll numbers. And letters poured into Congress. A department store treasurer was beating the United States Treasury in a public argument about taxes. The Roosevelt administration hated it because there was a catch, and the Treasury could count. Forgiving a year of taxes forgives everyone's taxes, including the people who owed the most. On February 11, 1943, Morgenthau sent President Roosevelt a memo with the numbers his department had run. Under the Ruml plan, an American who'd earned more than $1 million in 1942 would walk away at least $854,000 richer, comfortably north of $14 million in today's money. Verify conversion. In the middle of a war being fought by 18-year-old draftees earning $50 a month, the plan would hand its largest single windfalls to millionaires. Roosevelt, who had spent a decade building his politics on taxing wealth, refused point-blank to bless it. The administration's message to Congress was blunt. The boys overseas aren't forgiven their duty. Nobody at home should be forgiven theirs. And so, through the winter and spring of 1943, while the war raged from Guadalcanal to North Africa, Washington fought a strange, furious, months-long battle, not over whether to tax, but over whether to erase. Treasury had already helped kill the Ruml plan once during the debate over the 1942 Revenue Act, and now it pushed its own alternative, a stingier transition that delayed old obligations instead of forgiving them, keeping every taxpayer on the hook. The House of Representatives became the battlefield. Versions of the Ruml plan were voted down, revived, amended, and voted down again by razor-thin margins. Verify specific vote counts. With Democrats calling forgiveness a rich man's raid on the Treasury, and Republicans calling the administration's alternative a scheme to keep taxpayers permanently a year in debt to their own government. It got personal. Morgenthau was pilloried in the press as the man standing between 40 million frightened families and relief. Ruml, the amateur with the couch, was outmaneuvering the entire Treasury Department in the arena of public opinion. And all the while, March 15, 1943 came and went, with millions of brand new taxpayers scraping together their first ever payments under the old rules, wondering whether Congress was about to erase the very bill they'd just struggled to pay. Now, it's worth pausing here because it's important to be fair to both sides, and modern scholarship generally is. Morgenthau's numbers were real. Forgiveness genuinely did shower its biggest benefits on the wealthiest taxpayers. Historians who studied the episode don't dispute that. But Ruml's core insight was also real. In a world of continuous withholding, the lost year was largely an accounting illusion, and the government's actual cash flow would be stronger than ever. This wasn't heroes versus villains. It was two correct arguments pointed at each other, which is usually what genuine political deadlock looks like. But deadlock was a luxury the war would not fund. Every week without a decision, the Treasury inched closer to a March collision it knew millions of families couldn't survive financially, and revenue the war machine needed sat uncollected. Something had to give. And in June of 1943, in a compromise almost nobody fully loved, it finally did. Slow down with me here because this is the moment everything changes. On June 9, 1943, President Roosevelt signed the current Tax Payment Act. Here's the deal Congress had finally struck after months of trench warfare. The country would move to pay-as-you-go permanently. Starting July 1, 1943, 3 weeks after the signing, every employer in the United States was required by law to withhold federal income tax from wages at a base rate of 20% above exemptions, verify exact rate structure, and send it to the government on the worker's behalf. And the transition trap? Congress split the difference on forgiveness. 75% of 1 year's tax liability, whichever was lower, 1942's or 1943's, was simply canceled, erased. The remaining unforgiven quarter was due in 2 gentle installments in March of 1944 and March of 1945. For the great majority of ordinary taxpayers whose entire liability was modest, it worked out to something very close to what Ruml had promised. The old bill effectively vanished. An entire year of American income tax more or less legally ceased to exist. The only time in the nation's history that has ever happened. Think about what happened on that first day of July 1943. In one stroke, millions of employers, every factory, every shop, every office in America, were conscripted as unpaid tax collectors for the federal government. Payroll clerks who 3 weeks earlier had never seen a withholding table were now legally responsible for computing, deducting, and forwarding the income taxes of the entire national workforce. And tens of millions of workers opened their pay envelopes that month to find the number inside permanently smaller than the number they'd earned. No collector's office, no March reckoning with your checkbook. The tax was just gone before you ever saw it. There was grumbling, of course, but consider what didn't happen. No rebellion, no mass refusal. The country that had once required an army to collect a whiskey tax absorbed the largest expansion of direct taxation in its history in the middle of a work week, and mostly shrugged. Partly that was wartime patriotism, partly it was the forgiveness sweetener, and partly it was the deepest lesson of this whole story. A tax you never hold in your hand is a tax you find remarkably hard to miss. And here's the detail that gives this story its perfect ironic twist. The technical machinery of withholding, the tables, the rates, the mechanics of taking the tax smoothly out of every paycheck, had been developed inside the Treasury's Tax Research Division by a small team of economists. One of the young staffers who worked on it was named Milton Friedman. Yes, that Milton Friedman, the man who would become the 20th century's most famous champion of free markets and small government, the intellectual patron saint of cutting taxes. Decades later in his memoirs, Friedman admitted the uncomfortable truth. As a wartime economist, he'd helped build the collection machine, never imagining he was creating the tool that would let government grow into something he'd spend his life criticizing as, in his words, too large, too intrusive, too destructive of freedom. He defended withholding as a wartime necessity. He regretted forever that it never went away. One senator of the era reportedly captured the appeal of the new system with brutal honesty. It collected the most money with the least squawks. Verify attribution of the squawks, quote, because that's exactly what it did. Look at what happened next and how fast. In 1939, individual income taxes equaled roughly 1% of Americans' personal income. Within a few years of the 1943 Act, the figure was over 11% for us. An 11-fold jump in the government's claim on the average paycheck, accomplished with less public fury than the whiskey tax of the 1790s. Verify revenue figures for on-screen citation. By 1945, some 50 million Americans were paying, and the income tax had become what it remains today, the single great engine of federal revenue. And the machine had one more trick built into it, one that quietly rewired taxpayer psychology forever. Because withholding tables are blunt instruments, most workers had slightly too much taken out over the course of the year, which meant that when they filed their returns, the government owed them money. The tax refund was born as a mass experience. Almost overnight, the emotional climax of the American tax year flipped from writing a painful check in March to receiving a pleasant one in spring. The same transaction, the same taxpayer, often more total tax than ever before, and it now ended with the government handing you an envelope. It's hard to invent a better piece of psychological engineering, and remarkably, nobody exactly planned it. And then the war ended. The soldiers came home. The emergency passed. And withholding, the measure born of desperation, the idea America had killed twice before, simply stayed. There was no great repeal fight, no march on Washington. Rates came down somewhat from their wartime peaks, but the mass income tax and the withheld paycheck never went away. Not in 1946, not ever. The victory tax was folded away. The propaganda films went into the archives, and the extraordinary quietly became the permanent. The opponents of withholding had warned that it would numb citizens to the cost of government and make the federal state effortlessly larger. On the evidence, they were right. The supporters had argued that it would make paying taxes easier, fairer to people without savings, and vastly more reliable. That the old system of heroic, once-a-year lump sums was a machine built for a country where only the rich paid, and it would have crushed the new mass of taxpayers. On the evidence, they were right too. Hold both of those in your head at once. That's the honest version of this story. When you zoom out and look at this whole arc, from tariffs collected invisibly at the docks, to the tax collector's office on March 15th, to the deduction on your pay stub, you realize this was never really a story about rates or forms. It's a story about friction, about whether paying for your government should hurt, even a little, at the moment you do it. For 154 years, America kept the income tax rare but vivid. If you paid it all, you felt every dollar leave your hand face to face with the person collecting it. Since July 1st, 1943, we've run the opposite experiment. Nearly everyone pays, and almost no one feels it. Remember that line of taxpayers sneaking out of the collector's office at midnight? It's gone. It has been gone for 80 years, and its absence shapes your financial life more than almost any law you could name. Today, withholding delivers the overwhelming majority of individual income tax to the Treasury, a river of money measured in the trillions of dollars every year, verify current figure, flowing automatically pay day by payday from a couple 100 million paychecks. And here's the everyday absurdity we've all made peace with. Most American filers actually overpay through the year and then receive a refund, typically around $3,000. Verify current average, which millions of people genuinely celebrate. Think about that. We lend the government our own money, interest-free, for a year, and feel a small burst of joy when some of it comes back. Beardsley Ruml's pay-as-you-go scheme, Milton Friedman's tables, Donald Duck's cheerful example, all of it lives on in that strange little annual ritual, none of which means the machine was built for nothing. The withheld paycheck funded the defeat of fascism. It funded the GI Bill that sent a generation to college, and the interstate highways, and for better and worse, everything the modern federal government has done since. This isn't a villain story, and it isn't a hero story. The old world of face-to-face taxation was a world where government was small, partly because collecting money was hard, and it was also a world with no safety net underneath ordinary people when everything went wrong. The new world made government capable and made its cost nearly invisible. Whether that trade was better or worse depends entirely on what you value. But the question underneath it never got settled. It just got quieter. When the cost of government is something you never actually feel, who decides how big that cost gets to be? In 1776, and in 1862, and in 1913, and in that furious spring of 1943, Americans argued about that question out loud. Today it's answered silently, line by line, on a pay stub most of us never read. The tax collector didn't disappear in 1943. He just moved inside your paycheck, and out of sight. If this story changed the way you look at that pay stub, subscribe to the channel. This is what we do here. We go deep on the hidden systems that quietly shape your world, the ones built decades ago in rooms you've never heard of, that still decide how your money, your government, and your daily life actually work. And there's another one of those systems coming up next, because before 1913, America funded itself with no income tax at all, and how that worked is even stranger than what replaced it.